Your health and your wealth are linked, and a health savings account brings them all together. Welcome back to What's Next with Money. Coming up on today's program, is a health savings account right for you? It's the ultimate triple play or trifecta of tax savings. This is your health, and actually Congress hit the tax generosity button for you, your spouse, and your dependents. It's an HSA or health savings account. And health care is not cheap, and our need for it and the costs grow with age. Fidelity Investments has annually estimated out-of-pocket health care costs for decades. Its latest estimate for a 65-year-old couple is $300,000 in health care and medical expenses. And health savings accounts can help you lower and manage that number. Speaking of numbers, I think I'm a quart low, so I'm going to take this off. All right. So are health savings accounts worth it? We're going to give you information and context because that's what we do here at What's Next with Money, provide smart insights to guide your financial decisions. Let's get started. Health savings accounts are a hybrid type of account, and if properly used, it's a spending account for qualified healthcare expenses. Second, it's a savings account, and third, it can be an investing account. Now, these three, spending, savings, and investing, do not always go together in one unit. But if constructed right, you can get the best of these three money worlds plus a triple tax break. Now, here are the federal tax savings, and these will apply to most states as well that have a state income tax. Number one, contributing money to a health savings account with your after-tax money, you receive a tax deduction. And folks, the best of all, you don't have to itemize. You can claim the standard deduction like most Americans do and still get an health savings account tax deduction. Or if you're employed and your employer allows you to contribute pre-tax through a payroll contribution, that'll work as well. Or you can do a little combination of the both, and I've actually done that, up to the allowable annual limits. Number two, your spending on qualified health care expenses is tax-free. Number three, your savings and investing returns grow tax-free. So question I'd love to hear from you in the comments section, what's your advice and experience covering or hoping to cover health expenditures and saving for them in the future? Let me know what you think. Now, here's a big question. Who can contribute to a health savings account? The key criteria is you have to be enrolled in a high deductible health plan. Now, here is a list of ineligible health plans. If you're on Medicare, even Part A with no premium, no, you can't contribute to an HSA. If you have secondary health coverage, say from a spouse's plan that is not a high deductible plan, that will knock you out. TRICARE for the military and certain VA coverage knock you out. And you cannot be claimed as a dependent on someone else's tax return. You say, Brent, what is up with that list? Well, these are not considered high deductible plans by Congress and the rules they've set up. Your connection to those plans that are not high deductible means you can't contribute to a health savings account, and if you don't have one already, you can't set it up. But if you've had one in the past, you can keep it and let it grow for later use. And maybe your employment situation changes where you're not connected to one of those non-high deductible plans. Bottom line, it's your health savings account. You own it and control it. Now, there are a few other requirements regarding allowable high deductible plans. They have to meet certain out-of-pocket maximums and minimum deductibles. We're not going to get into that, but I have a link to an IRS publication that explains it, and your HR professional can help as well. Next, how much can I contribute to a health savings account? Now, for 2022 for an individual, it's $3,650 an individual. That's pretty good. For a family, it's $7,300. And if you're over 55 or older, you can add a catch-up contribution of $1,000 to each of those. Now, you can contribute up to April 15th of the prior year. This is very much like an IRA type contribution, but there are still a lot of differences. Now, record keeping is a big part of contributions and spending from health savings accounts, and the IRS will be right at your side the whole way, monitoring what you're doing. And as you make contributions, you're going to receive an IRS form. Now, on the spending side, what is a qualified medical expense? Now, here's a partial list, and I don't think you're going to be disappointed. Ambulance, acupuncture, artificial teeth and limbs, crutches, dental, including braces, doctor's visits, hospitalization, nursing home, prescriptions, physical and emotional therapy, vision, exams, glasses, contacts, x-rays, and there are a lot more at another IRS publication we're going to have a link to. And by the way, these IRS publications are pretty easy to read. They have good checklists, and I think they can help clarify a lot of questions. Now, here are some special premium payments that a health savings account deems as qualified expenses. So these are like insurance premiums that your HSA you can spend toward. And these are big. Qualified long-term care coverage, COBRA coverage, health care premiums while you're on unemployment, and some Medicare premiums if you're over 65. Next, we're going to look at how to use the health savings account. But first, be sure to hit that subscribe and smash that like button. This helps move our content at What's Next with Money to others who enjoy this learning about personal finance and future trends. Now, we're talking about using and spending from a health savings account. And each year, the IRS, as I said before, is going to be right at your side. For any use or spending from that account, you're going to receive a 1099 SA form to show the distributions you've made. Now, you will need to keep receipts of those qualified expenses, and if not, or they're not qualified, you're going to pay a penalty if you're under 65, plus a tax on those withdrawals. Now, we talked about a lot of the spending patterns, and prescriptions are part of that. But is it just for me? Well, yes. But it's also can be for your spouse if they're registered on the account, or your dependent if they're registered. And you do not have to use it. This is not a use it or lose it account like an FSA or flexible spending account. Those kind of accounts are actually set up at your employer, and they own and do a lot of control over it. By the way, it's not advisable to have a flexible spending account and a health savings account operating at the same time, as they may work at cross purposes. There are limited exceptions, but check with your HR professional. Now, personally for me, the health savings account has more ownership, wealth growing power, and control than a flexible spending account. Plus, the health savings account lasts in and through retirement. A flexible spending account, FSA, is per each year. Use it or lose it. And if you change jobs, you can take that health savings account money with you. You can transfer it to another financial institution, or you might be able to leave it in the financial institution your employer set up for you at the time. And hey, here's a bonus for all age 65 or higher. Once you hit that age, you are not subject to the health savings account withdrawals and getting hit with a 20% penalty for spending, check it out, on non-medical expenses. So that list I cited, you can kind of ignore that as you're older. But this is a big break. You'll still have to pay tax on the non-medical withdrawal, but not an extra penalty. So bottom line, with that triple tax advantage I mentioned using health savings accounts for medical supplemental spending in retirement, that's a better move using that HSA money than actually spending medical dollars from your retirement funds. Those retirement funds are really designed to last a long time, but the HSA allows you to compartmentalize that spending in a very tax efficient manner. Now, the tricky part of all this is the interplay of spending, saving, and investing. We have covered health savings accounts as a transactional account, a spending account, and usually with those you get a debit card, maybe some checks, and of course you can just pay the medical expense, have the receipt, and seek reimbursement from your account, basically pay yourself as long as you keep those receipts. And this can be all done out of a bank, credit union, or brokerage firm that offers health savings accounts. But watch out for those monthly fees, and the interest you might earn on your savings will likely to be modest because this is mainly a spending account. Now, you can let your balances rise through contributions, possible employer matches, and modest interest earnings. So that's kind of the spending side. But savings is a possibility, and you may have a goal not to spend for many or most of those qualified medical expenses. You might want to do it out of your own pocket. This allows you to build up the health savings account balance in those numbers for later use into retirement or for a big out-of-pocket medical stress periods. And folks, these do happen to many families that you or your family might encounter. So you might think of the health savings account as like a giant, large medical expense emergency fund. That's a really cool idea. So we've talked about the spending, the savings, but what about investing? Now, this can be a separate account into a mutual fund, ETF, exchange traded fund, or even a target date fund. And now some financial institutions are offering dedicated health savings account investment accounts for the long run and to pace with inflation. So in essence, you can kind of run two HSA accounts at the same time under the same financial institution umbrella. Now, these investment accounts have investing and growth potential, but the risk level of them should be moderate or low because the money can grow, but the principal needs stability and a bit of preservation for later use for medical spending. And with medical spending, we have to think of this as a shorter time horizon of use and the need to access the money rather than the longer term time horizon of retirement money. Now, let me tell you my short health savings account story and journey, and I've learned a lot. When I left my most recent salary job, I maxed out all my health savings account contributions. Now, in the early days of the account, our company generously seeded with employer contributions to start the savings account as they were transitioning our health insurance from kind of regular health insurance to a high deductible medical plan where we as employees were going to be responsible for many of the first dollars spent. Now, even after they stopped contributing to help build up some of those early savings, I stepped up and got the maximum contribution, and I was really seeking that maximum tax deduction. But I never spent the money. The monthly fees in those accounts were a bit high. And when I left that employer, I transferred the entire health savings account to a new financial investment firm. I placed 75% of the money saved, now finally investing in one of those health savings account investment accounts, and then 25% in a money market checking account with a debit card for medical spending purposes. Now, I'm perhaps an unusual case. I still haven't spent any health savings account money on medical issues. I chose to do those out of pocket. My family is very healthy. We engage in preventative care, good nutrition, a variety of regular exercise. And I deem these savings funds in these two buckets, these two pockets, for medical out-of-pocket expenses in retirement. Because I have this long-term focus, I wanted a big portion of the money to grow in the new financial firm's health savings account investment fund. And the cool thing about this is the fund is structured to not be very volatile. It seeks stability. And the way it does that, it has less than 50% of the allocation of assets in that fund to stocks. So it is kind of on the conservative side, and that's good. So we need to compare spending account fees and the longer term health savings account investment or savings account options and their fees as well. Now, what happens if you, the health saving account owner, dies? Health savings accounts all have a beneficiary designation form. So if you have a spouse, be sure to list them. When you die, the spouse puts their name on the health savings account and runs it as if it is theirs. Now, if you put your child's name or a non-relative on it, let's say you don't have a spouse or the spouse has passed away, here's what happens. If they're listed as a beneficiary, this is like non-spousal beneficiary, they get the account after your death. That account suddenly becomes a taxable distribution. There ain't no rollover chance. This is not like the IRA world or 401k. Those non-relatives or children have 1 year from the date of the owner's death to spend it. What's left over is instantly taxable, and your children can spend out of that health savings account like crazy during that year, but they have to do it on qualified medical expenses and then pay no tax. If they violate that, they're going to have to pay some, and they can aggressively draw that account down. Now, there is an alternative to this, and this could be listed as a secondary beneficiary depending on your relationship with kids or non-family beneficiaries. You could list a charity as a health savings account beneficiary, and no tax is due at all, and the charity receives that money tax-free. So you see, health savings accounts have a few attributes like an IRA, and they sometimes get confused with flexible spending accounts or FSAs. But it is very different from both, and if handled properly, is one of the most tax generous or financially beneficial spending, savings, and investing accounts the federal government has ever created. So be sure to hit that subscribe and like button, and don't forget to share this video and others. Remember, new episodes of What's Next with Money are posted for you on Thursdays.